Okay, good morning. If you're online, we do not have a video feed right now. Okay, on the screen is the Learning Catalytics session ID. We do have a question out there to be answered. The session ID for right now is 406 26258. And we have a question being delivered right now, so you can put that up. No, you don't need this. Right. There. Okay. So make sure you click in a couple questions that we had before class started. If your My Accounting Lab access has expired, you won't get credit if you're not answering questions. This is what we do in class each day. Keep in mind at the end of the semester, your 3 lowest quiz scores are dropped, which includes a day of class. So that's in place to ensure that, if something like this happens, you know that it can be dropped. You have 3 of those drops available. So this would just be one of those. So what we're going to do is this question asks about calculating net income. You're given some information. And remember, when you enter your answer, do not answer dollar signs or commas in your answer. And also know that today is still participation based. So if you get one wrong, you're still going to get credit. Last week, if you were signed into Learning Catalytics and answered at least one question, you got credit. Today, you have to actually answer every question to get credit for that question. So last week we were kind of a little looser since it was the first time we did it for real, so you could answer a couple questions and still get full credit. Today, if we get, I don't know how many questions we have today, but let's say we have 10 questions today and you answer 7 of them, your score for today is going to be 70%. So, and it doesn't matter today if you get them right or wrong. Hopefully you get them right. But so it is participation based, so you need to make sure you answer all of the questions. And this first question that we have up here, right now we have 277 students online. We have 190 responses. So we're going to leave it open for about 10 seconds. We're going to have 10 seconds of silence. If you haven't had a chance to do it yet, I suggest you answer a guess, because remember, you would still get credit. If there's not an answer in when we close it in 10 seconds, then you're going to not receive credit for the first question, which is not a huge deal in the overall scheme of things, but you want to get it if you're here. So if you're walking in late or got a late start, just get an answer in there. So 5 more seconds, Haley, and then close that one. On your screen now for your device, you should see the answers being listed. If you don't, there is a refresh button. You can hit a couple times when I start talking about it. Okay, I need people to quit talking. I'm hearing a lot of chatter, and it's hard for me, not to be mean, but it's hard for me to talk while conversations are going on around me. So when we're having class, I would ask that you not talk if I'm talking, because it's just hard. So thank you. This question, when we had this question, we were given revenues minus expenses. That is net income. Revenues minus expenses. So the answer to this question is 200, because we had revenues of 300, expenses of 100. So the answer to the question, 300 minus 100, $200 is our net income. The distractor here was dividends declared and paid were $25. Dividends never impact net income. Dividends are considered a return of capital to the owners. They are not an expense. Never, ever, ever. So when you see net income, it's going to be revenues minus expenses, net income. There we go. So that was the thing with this one. So 70% of you got this answer correct. The other people, you want to make sure that you're not subtracting dividends when you're getting net income. What we're going to do now is we're going to take 2 minutes, and Haley's going to talk about Accounting Association.
Can everybody hear me okay online? Okay. So most of you guys probably only know me as your graduate assistant, but I'm also the president of the Accounting Association here on campus. The Accounting Association is a group for all accounting majors or students who just have an interest in accounting. So if you're interested in being an accounting major but you're not one right now, you can absolutely join the group. We meet every Wednesday at 5:15 p.m. in room 115 in the business building. And every week we have professionals come and they'll speak to us about topics that are relevant to the accounting field. All of these presentations are going to be really helpful to you in your academic and professional career. They're going to talk about things such as how to get an internship, how to format your resume, stuff like that. On top of our professional meetings, we have tons of social events and tons of community service events that we do too. This past Sunday, we went to Art in the Park, which is at Park in Kent, and we volunteered and we got to make crafts with little kids, so it's pretty fun. And then we also did a tailgating event for the football game on Saturday, which was really fun too. Something that I always like to say, at the end of last year, I did a quick survey to all of our members. 45 out of 47 of our members that were eligible for either jobs or internships told me that they received a job offer or an intern offer through coming to our meetings. So if you want a job, I highly recommend you join. It's going to get you to get in front of the recruiters and get to know them on a more personal level before you're going in front of them to interview. So like I said, our meetings are every Wednesday at 5:15 p.m. in room 115. And if you have any questions about joining or anything like that, you can always come up to me after class or shoot me an email. Thank you.
Okay, thank you. We're back on audio, right? You can hear me online again? Yep, good. Okay, I would encourage you, if you have any interest in accounting at all, to go to the meetings, that they are a wonderful networking opportunity, and the firms are making presentations about different facets of accounting every week. It's not about the technical details, so you don't go study accounting at the meetings, but what you're learning about are the professional side of accounting. Now, next up, what's due this week? So this isn't due till Saturday, but just to reiterate, Chapter 2 homework is due this Saturday. In my accounting lab, if you're in sections 1, 2, 7, or 8, that's what you have due this week. The Chapter 2 homework, this Chapter 2 is huge. The impact on the rest of the semester cannot be overemphasized. You need to know this Chapter 2. The Chapter 2 homework is one of the heavier homework weeks in the semester. So just giving you a heads up, it might not be a bad idea to at least start it today. We're going to do one homework problem today. We have a lot of lecture stuff before we get there, but we have one homework problem today. It would be a good idea to start and start looking at what we're doing. We have a lot we're doing in class on Wednesday, and then we have the optional Friday session. I will guarantee you we're going to do a lot of practice on Friday, and again, it would be something I would really urge you to pop in if you have that time available. And we realize not everyone can be available on Friday morning at 8 a.m. And it's recorded. So if you do need, as you work through your homework, if you need the extra help, look for that supplemental session recording. And then if you're in section 3 only, which is the small section, if you're watching this later, not only do you have the homework due this week, but you also have a quiz in My Accounting Lab. The quiz in My Accounting Lab is only for section 3. So if you're in class here, you're doing the quizzes via Learning Catalytics. So today, transaction analysis. If you took accounting in high school, this chapter is going to feel pretty familiar. Maybe not totally familiar, but it's going to feel okay. If you've never had accounting before, this is going to feel like a foreign language. And it's going to be hard and you're going to struggle with it because no one has a natural gift for accounting. It's a made-up field. It's what we've made up to keep track of everything, to score keep. So this is not natural to anyone. It requires practice. And it's just a matter of practice, practice, practice. I will refer to a couple times to what you should put on your exam sheet. When you take your exam, you won't be allowed to take an 8.5 by 11 sheet of paper, writing on both sides or typing on both sides. And we'll talk more about that later. But the point is you get to bring this sheet of paper with you. So you don't have to memorize everything we're doing. And there will be things, and I did this last week, where I say, I would put this on my sheet. Okay? And I'm going to do that today. I'm going to tell you about some things I would write on my sheet. We have some of those today. So I would start that sheet, or at least have one piece of paper where you're recording these things, so when you go to prepare your sheet for the exam, you have a list of those things. Because I'm not going to prepare your sheet for you. That's part of the learning and the reinforcement is putting it all together. So we're talking about transactions today. And first of all, we're going to start with transaction, what it is. Okay. I'm going to go a little out of order. If you have the online slides, they contain most of what we've got here, plus some extra. And I think the online slides are good, but I don't go over every single slide in class. We have a transaction. Transactions, financial transactions are what we record. And every transaction has two sides. Essentially, you're giving up something and you're getting something. Okay? So if I go to the store and buy milk, I'm giving up cash and I'm getting milk. There's two sides to that transaction. In business, the same way. Everything has two sides. We have to record both sides. Everything we do in this class, unless we say otherwise, is recorded from the side of the business. If I'm a business owner, I'm a person too. So let's say I give my business $50,000 cash in return for stock. When we're recording this in class, we're recording it from the standpoint of the business. So I would not record the personal transaction. That's separate. When we're looking at recording all these transactions, keep in mind we're recording them for the business entity. It doesn't matter if it's a sole proprietorship, a partnership, a corporation. We are recording it for the business. The business is a discrete entity, so we're looking at it from the business standpoint. Okay. Now, when we record transactions, we record them in accounts. And an account is simply a running total of a particular item that we're interested in. The easiest one to talk about is cash. When I'm running a business, I need to know how much cash I have. So every time I get cash, I record it in the cash account. Every time I spend cash, I record it in the cash account. So at the end of the period, I know how much cash I have. Cash is an account. I also have accounts to record my revenue and my expenses. And at the end of the period, I get the totals for those. And an account is simply a running total or a summary device to be able to know how much I start with, what happened to it, and what's the end total. So we have different types of accounts. We have three groups of accounts, and those three groups of accounts make up the accounting equation. We have assets equal liabilities plus equity. So what we're going to do now is, if you have the slides online, they're great. There's several slides. They give you a lot more detail. In this case, I summarized them on one because I don't want to write down all that in our time here. So assets. On my sheet for the exam, I would absolutely positively have a list of possible assets. These are not all the assets that exist, but these are some common ones. And you'll see later in class when we talk about assets and liabilities, rather than memorizing this, I can look at the list. So this list of assets, these are common assets. Assets are things that have future economic benefit to the company. They can be used up or not, but we have cash. Cash obviously has value to the business. Accounts receivable. Accounts receivable is what our customers owe us. What is owed to us? It's like IOUs. People are going to be paying us this. Notes receivable is where we've loaned money out and people owe us money. So we actually have loaned money out. They signed a note. That's the difference between accounts receivable and notes receivable. A note receivable, there's a promissory note where somebody signed it and they owe us the money. Inventory is merchandise we hold for sale as part of our business. We have prepaid expenses. Prepaid expenses are one of the only accounts that has another word in it that makes you think it's a different kind of account. Prepaid expense is not an expense account. It is an asset. Prepaid expense is an asset. For example, I guess an example would do. Progressive insurance. If you pay for your car insurance a year in advance, you get a 10% discount. So oftentimes businesses will pay for insurance for a year in advance. When we pay for that insurance a year in advance, we have an asset that's going to be used up over the course of the 12 months. So on the date we pay it, we have an account called prepaid insurance. It's an asset, and it will eventually turn into an expense. That's why it's called a prepaid expense. So when you see prepaid expense, it is an asset. Next up, land. That's pretty self-explanatory. Buildings that we own, equipment, cars, things like computers, those are all considered to be assets. We call it furniture and fixtures. We might call it property, plant, and equipment, but those are assets, and then we have more assets called other assets. But those are sample types of assets. So I would have that list handy. Coming up, we're going to do sample types of liabilities, and we're going to do sample equity accounts as well. And we'll see that in play when we do the homework problem for today. You'll see it's good to be able to identify an account as an asset, liability, or equity. So those are assets. Next up, liabilities. Some common liabilities. Accounts payable. This is when we go out and buy something, and when I say we, I mean the business. So the business goes out and buys 6 cases of paper from Office Max. That's an accounts payable. They get the paper and they say, we'll pay you later. That's accounts payable. We owe our vendors, and that's a liability. Notes payable, we borrow money. We sign a promissory note. The bank gives us money. We give them a signed note. That's notes payable. Accrued liabilities are liabilities that we owe but we haven't paid yet. An example would be my utilities expense for last month. Today is, so let's say at the end of August, we used electricity the whole month of August. Well, the electric company is not going to bill us until the second week of September. But August 31st, we know that we owe the electric company. We just don't have the bill in hand. So that's called an accrued liability. Short-term note payable, that's just saying, well, if this is due within a year. The current portion of long-term debt, I just wanted to list that here so that you would know it actually is a liability. But if I have a 30-year mortgage, I know I'm going to make payments for the next 12 months. The principal part of those next 12 months is called current portion of long-term debt. Our investors, when investors use our financial statements, they're really interested in our debts over the next 12 months. They want to know, can we meet these obligations? And that's why you see this emphasis on current versus long-term. And then we have mortgages payable and long-term notes payable. So those are sample liabilities. We're going to talk a lot more about those. But those are good examples, and those are good to have beside you even when you're doing the homework to say, oh, what do I know about what's going on? You can at least identify, do you have an asset here, a liability, or an equity? And then equity accounts. And we're kind of light on the equity accounts here because we're going to get in more detail as we go forward. But there's 2 types of equity accounts. paid in capital, of which common stock is a big chunk. So we have common stock and retained earnings. So those are our two types of equity accounts. Now, within retained earnings itself, there are three types of accounts. We have revenues. Revenues increase retained earnings. That's why I have a plus symbol after revenues. Expenses decrease retained earnings, and so do dividends. So revenues, expenses, and dividends are all equity accounts, and they all have impact on retained earnings. So we're going to go back and do two questions before we go any further. The first question up here is identifying which item is not a transaction in the accounting record. So which item does not fit? Out of about 350, we have 304 responses. The response window is closing, so you want to get an answer in there. Again, make sure you have an answer so that you receive credit. The following business events would not be recorded. You have to have, just as a reminder here, you have to have a transaction that can be reliably measured. So another 5 seconds, Haley. How close are we? This is your last chance. You should see that you've answered. Okay, of those transactions, the first three are transactions. We paid a monthly utility bill. We have a check. We can measure that. That was a transaction. B, company issued 100 shares of common stock. That can be measured as well. They got some amount of money for it, so that's a transaction. Entry C, the company purchased 2 acres of land. That is certainly a transaction. They gave cash, they got land, that can be measured. Entry D, the company signed a contract to provide services in the next accounting period. So all they've done here is signed a contract. They have not performed the services. This is a good thing that happened, but it is not a financial transaction. It is not an accounting transaction. We don't have anything to measure. Okay? So we're not saying it's not important, but it is not recorded because there's nothing to record there. Okay, we're going to do one more question now. And again, if you're not seeing the responses, there's a refresh button right in Learning Catalytics there. Which of the following is an asset? If you get one of these questions on the exam, you should be celebrating because you have a list. These are give me points when you see these. I'm not going to touch it. I'm just going to go on here. If you're multitasking, can you tell me where we are? If you're online, we're down one computer right now, so Haley's typing on an iPad in the chat window and listening to me. Okay, we have about 50 people left to answer. You pick. This should be a really easy question. We went over, we said, here's a list of assets, here's a list of liabilities. Pick your answer, select your answer, and enter it. And we've got 5 seconds and we're going to close. Two more people. Close it. Okay, which of the following is an asset? A, retained earnings is equity. B, accrued liabilities is a liability. C, accounts receivable is an asset, so that was the answer. And D, accounts payable is a liability. If it says payable, it's a liability. So those are the kind of questions you should be very happy to get because you'll be able to identify on your sheet. Okay, let's go. Now it's me, right? Now we're getting into the main heart of this chapter, recording transactions. And this is where it can be really confusing. And I know that at first. And I'm going to try to give you, we're just going to jump in. We're going to do it. We have a lot of practice coming up on Wednesday. And then on Friday we're going to do the supplemental session. So hopefully you can catch that at some point since it is recorded if you're not there live. So we're going to just, with transaction analysis, I'm just going to do an example. Now this example, we have a doctor that opened up a medical practice, and we have to analyze the following events on the accounting equation of the medical practice. Now if you're an accounting major, this you should be interested in. You know that you need to know this. If you're not an accounting major, why should you care about transaction analysis? The reason is you'll make decisions going forward in business. So you might be in a for-profit business. You need to know how your actions affect the bottom line. We have a profit motive in many cases, and we want to make sure that what we're doing supports that profit motive. So you need to understand how it has an impact. If you're in a nonprofit, you have limited resources. You need to know what you do, how it impacts the organization. So these are transactions. You probably won't, most people won't be recording transactions, but you need to understand that process and what happens. So the accounting equation is a representation of the balance sheet. And the accounting equation is assets equal liabilities plus equity. We did that last week. And what we're going to do now is we're going to set up a representation of the accounting equation, and then we're going to record a series of transactions. So what I've got on the screen here is the first transaction, but even more importantly, below that, if you're taking notes by hand, I would suggest this is where you take a fresh piece of paper, turn it to landscape mode, because we're going to have several column headings, and I'm going to give you time to write this down. But we have a column heading first for the date, and then we have assets. And our assets are listed on the screen. We have cash, accounts receivable, medical supplies, and land. So those are all assets, and they're titled assets. And then next over, we have liabilities, accounts payable, notes payable, and then finally we have stockholders' equity, which is common stock and retained earnings. So what we're going to be doing is we have about 10 transactions that we're going to record the impact of. So if we're going to take a minute or two now, let you write those headings, because then we're going to go transaction by transaction. The first transaction is actually written at the top of the screen that we'll be doing. But again, I'm going to go silent for a minute or two, let you write those headings down, and then we'll go forward. You could do, learn calculus on this one. Do collaborate on this one. Sign back in. Here. I'll be looking over your shoulder at that one. Here you go. Okay, good. If you're watching this later, we are just taking a little bit of time to set up these headings because we're going to need them as we record the transactions. Let's get started on this now. So we have this transaction, we have a series of transactions, and the first one is listed at the top of the screen, the words. So Dr. Luke invested $100,000 in the business in return for common stock. So we're looking at saying, how does this impact assets, liabilities, and equity? Dr. Luke invested $100,000. So that says $100,000 in cash is in play here. Oftentimes on transactions I say to myself, is cash involved and does it increase or decrease? Because cash is easy to conceptualize. So in this case, and remember we're recording from the standpoint of the business. So what's the business getting? The business is getting cash. Cash is increasing. So we're going to put a plus $100,000 under the cash column. Every transaction has two sides. So we have cash increasing. The other side of this is, what was the other side? The business got cash. Why did they get cash? Well, they got cash because they're giving common stock. So that's equity. So we have a $100,000 increase in equity as well. So we have cash increasing by $100,000 and we have common stock increasing by $100,000. There's no need to reason through all of these every time. Whenever we issue common stock, we're going to be debiting cash and crediting some version of common stock. That's the transaction. Well, and I'm sorry, I didn't mean to get into debits and credits. I just went there with that. But we're increasing cash and increasing equity at the same time. So that is February 1st. Notice out in the date column I'm putting the date. We want to make sure we can cross-reference back to where it came from. The next transaction at the top of the screen just changed. The business borrowed $50,000, signing a note payable to the bank. So again, I look to see is cash involved. The word cash is not there, but it is involved because what do you borrow from the bank? You borrow cash. So okay, so we have $50,000. We know it impacts cash. Does it increase cash or decrease cash for the business? It increases cash for the business. So we're going to have a $50,000 increase to cash in the cash column. And then we have to have two sides to every transaction. Every transaction, the accounting equation has to balance. So the other side of this, the business borrowed $50,000, signing a note payable. Note payable also increased. We now have a liability that we didn't have before. So we're going to have an increase to cash and an increase to liabilities in the form of note payable. The first four columns you have, the cash, accounts receivable, medical supplies, and land, all get added together, and those are assets. The next two columns are liabilities, and the final two columns are equity. At any time, we can add all the numbers on the asset columns, and those would equal all the numbers with the liabilities and equity added together. We have to be in balance every time. Every transaction has to be in balance. So our assets have to equal the effect on liabilities and equity every time. Next transaction, the business paid cash for land costing $105,000. So we have cash for land for $105,000. So the first thing I ask myself, is cash involved? Yeah, we paid cash. Now this time, cash is not going up. Cash is decreasing. We're spending cash to get the land. So what we're going to do is we're going to show cash as a decrease. So we're going to put brackets around it. So we'll see cash going out with the brackets around it, the parentheses around it, saying this is our cash that is decreasing. Cash is decreasing. The other side of this transaction, we gave up cash. What are we getting in return? We're getting land. So we're going to have an increase to land. This is a transaction where one asset increases, land, and another one decreases, cash, and so they cancel each other out. We still need to record it because we want to know how much cash we have. We don't want to lose the $105,000 somewhere. We need to note that it's happening to cash. Next up, the next transaction we have is the business purchased medical supplies for $1,700 on account. So that's our next transaction. We'll say more about this in a future class, but when you see the words on account, those two words have very specific meaning. On account means that it's one of two accounts affected. One is accounts receivable and the other is accounts payable. Accounts receivable is what people owe you. It's your customers. This is a transaction where you sold something to your customer. They said, we'll pay you in 30 days or whatever. But accounts receivable is dealing with customers and what people owe you. Accounts payable is what you owe your suppliers or your vendors, and it's what you owe others. So accounts payable, you go to OfficeMax, buy 6 cases of paper, and you tell them we'll pay in 30 days. That's accounts payable. You owe OfficeMax. So when you see on account automatically means accounts payable or accounts receivable. So you have to make that choice. So back to this. The business purchased medical supplies for $1,700 on account. So $1,700 is the amount. The first thing is, what did they get? They got medical supplies. Presumably, these medical supplies will be used up over the next few months, maybe the next year. They're not going to be used today. So they're an asset. So they're going to go into an asset called medical supplies or supplies, something like that. So we have an asset increasing by $1,700. So now we have to record another $1,700 to keep this in balance, and that's where that on account comes into play. If it's accounts receivable, it's a transaction involving a customer of ours. If it's accounts payable, it's a vendor or supplier. So, and it's where we owe the money. So in this case, it is accounts payable. Okay, there's no customer involved here. This is, we're buying supplies, we now owe the money. So this is going to be a liability, accounts payable. So in this transaction, the business purchased supplies, so the asset, medical supplies, went up, it increased, and accounts payable, the liability increased because now I have a debt for $1,700. Next item, February 12th. The doctor's medical practice officially opened. So up to this point, medical practice is getting organized, issued stock, got some supplies, they're ready, they opened for business. There's nothing to measure there. There's nothing to be, I mean, it's a significant event. You would write it down somewhere, keep a record of that, but it is not an accounting transaction. So when we officially open for business, there is no accounting transaction there. It can't be measured. There's no monetary value there that can be measured. I mean, there's certainly value to what we did by going into business, but we can't record it. Next up, we have the next transaction. Dr. Luke treated patients and earned service revenue of $5,600, receiving cash for half the revenue. So this one's pretty complicated. We've got a couple things going on. First thing I want to do is I want to look at this and I say, I've got to have an equal impact on both these sides, on assets, equal liabilities plus equity. I have revenue of $5,600. So right away I could say, oh, I earned revenue. What did I get? I earned revenue. So I can increase retained earnings out in the far right column because revenue is an equity account. So, and revenue increases equity. So I'm going to have $5,600 out of retained earnings. So what else here? Is cash involved? Yeah, cash is involved. It says receive cash for half the revenue earned. Okay, so half of $5,600, so this just means patients did their copay or they paid part of it, but Dr. Luke got half of the $5,600, so $2,800 I believe. $2,800 was cash. So I'm going to put $2,800 in the cash column. And it's an increase because we're getting cash. So we have $2,800 in the assets, and I have $2,800 or $5,600 out in the retained earnings. My accounting equation does not balance now. There's a piece missing, another $2,800. That $2,800 that's missing is patients who have said, you know, when you go to a service provider and sometimes they'll say, oh, give me your copay, we'll bill you for the rest. Let's imagine that's what happened here. So the patients are going to pay later. So that's accounts receivable. So what we see here is we're increasing cash for $2,800. We're increasing accounts receivable for $2,800. And then service revenue, which is part of retained earnings, gets $5,600. And I just wrote service revenue out here so we would know, since it doesn't say retained earnings. Next transaction. The business paid employee salaries of $2,300 for the first half of the month. Transaction here. We've paid $2,300. So is cash involved? Yes, absolutely. Cash is involved. Cash is decreasing. So we put $2,300 in the cash column, put parentheses around it, and now we look for the other part of this. We paid employee salaries. We don't have a specific account listed here that we talked about, but when I pay salaries, that's going to be expense. So this is an expense, and expenses reduce retained earnings, so I'll have salaries expense, and I put brackets around it because the impact on retained earnings is to decrease retained earnings. We have 2 more transactions here, and then we'll answer a series of questions about what we did. The next transaction, Dr. Luke treated patients and received $1,500 cash at the time of service. First question I asked myself is cash involved? Yeah, received $1,500 cash. So I'm going to increase the cash column by $1,500. And then the other side of this transaction, why did Dr. Luke get $1,500? For performing services. When we treat patients, that's service revenue. So we're going to see cash increase by $1,500 and retained earnings also increase because service revenue increases retained earnings. And then our final transaction here I'm going to take that question in just a minute. I'm going to go through this transaction and then answer the question about why we don't have the expense column. Okay, so this last transaction, the business paid office rent of $1,000. We pay office rent. So cash is implied there. It doesn't say cash, but how do we pay rent? With cash. So we're going to reduce cash by $1,000, and then we're going to also expenses reduce retained earnings. Now, we had a question online that said, why don't we have columns for revenues and expenses? The reason we don't is because it would get overly complicated for what we're trying to do. What we're trying to do is show that revenues and expenses impact retained earnings. They're subsets of retained earnings, so it would just get too cumbersome to have all these columns up here. The question is, couldn't rent be under accounts payable because you owe the money? That would be true if it said that, if it didn't say we paid it. The reason, you have to, sometimes there's subtle differences, but when it says paid, that means we paid it. Okay, so you see the word paid, let's assume unless otherwise told that there is cash involved in that transaction. But that was a good question. We're to the end of our transaction. So what we're going to do next is, we're not leaving this. Oh, we have one more. Sorry. I was thinking we were done. Okay, one more transaction. The business paid $500 on account. So again, we just said, you see the word paid, that implies cash is involved. So if we paid $500, the impact on cash is going to be, it decreases cash. So we're going to have a decrease for $500 in the cash column. Now, what did we pay? We paid those words on account, they come up again. So automatically when I see on account, I know it's accounts receivable or accounts payable. Accounts receivable is our customers, dealing with our customers. They're paying us, they're buying our stuff. Accounts payable, we owe. And if we paid money out, we have to be paying on what we owe. So in this case, it is accounts payable. So our transaction is going to reduce cash by $500, and it will also reduce accounts payable. If we paid it on account, we're reducing our liabilities. The next thing we're going to do is we're going to answer a whole series of questions, 5 questions on this. But what we need to do before we get there is we need to add our columns up. So what we're going to be doing is we're going to be adding the cash column. And when I add the cash column, I'm going to be adding 100,000 plus 50,000, subtract 105, add 2,800, subtract 2,300, add 15, subtract 1,000, subtract 500. I always like to say that because somewhere along the way someone won't realize that the parentheses mean to subtract that. So you want to make sure you add the ones that are positive and subtract the ones with parentheses. You'll get a total. What that is that's the balance of your cash account. That's really important to know as a business, and that's why we do this transaction recording and the impact. So we're going to add each column down. So what we'll get is $45,500 for cash, Going over to accounts receivable, we add the column 2,800, medical supplies 1,700, land 105,000. Those first 4 columns are assets. So if we add the first 4 columns together, we get 155,500. I think there's an extra 5 in the slide here. Let me fix it. Yeah, yeah. Okay, 155,000. And then we go over to liabilities and we add accounts payable. We get 1,200. We have the 1,700 less the 500 we paid on it. We do the same thing for notes payable. There's only 1 transaction, and common stock and retained earnings. So we end up with all these totals of our columns. Now, when I add up my liabilities, I get 155,000. When I add my columns for liabilities and stockholders' equity, so I add accounts payable balance, notes payable balance, common stock balance, and retained earnings balance, I add those together, I get 155,000 as well. Those are my totals at the bottom. That means my accounting equation is in balance. If my assets did not equal my liabilities plus equity, I would stop here. It's absolutely wrong. Something is missing. This is not, when your assets equal your liabilities and equity, it's not a guarantee that everything's right, but what it tells you is you did the arithmetic correctly. But if it doesn't balance, so when we talk about balancing, we're talking about assets equaling liabilities plus equity. If it doesn't balance, it is absolutely wrong. There's something missing, so you have to go back. So now we're going to answer, if you have the slides, you'll have a list of questions. I'm just showing you that we're going to be answering these questions, but these questions are at the top of every slide I'm going over. So we're answering these 5 questions. The first one is, how much are total assets? You've got that on your sheet. Total assets are going to be 155,000. So that's the total of those 4 asset accounts across. That's where I add the 45,500 plus 2,800 plus 1,700 plus 105,000. That gives me 155,000. Okay, next question is, how much does the business expect to collect from patients? Well, how much the business expects to collect from patients, it's also, you could think customers, because patients are customers. That's going to be a receivable account. Here we have accounts receivable, so that's 2,800. So all we're doing now is focusing on the questions that we could answer given that we have this information from recording all our transactions. So 2,800 is how much this business expects to collect from its patients at this date. The next question asks, how much does the business owe in total? So what are its liabilities is another way of asking that. Well, our total liabilities, I add up accounts payable and I add up notes payable, and I get the 51,200. So that's their total liabilities. The next question, so I have 2 more questions with this. The next question is asking, how much of the business assets does Luke really own? This goes back to the several days ago when we talked about I have assets, I have debts, I owe, liabilities I owe. So if I take what I own, subtract what I owe, I get my net worth. This is asking for the net worth of the business, which is the equity of the business. So to answer this question, we would take we would add up the equity, which is going to be the common stock plus the retained earnings. So if we add that up, we get $103,800. That is the equity of the business, and that's how much the owner or owners actually owns of the business. That's their equity in the business. And then the last question being asked here is how much net income or loss did the business experience? Well, to get that, we're going to take all our revenues and subtract our expenses, which are actually in the retained earnings column. We have sales revenue and we have expenses listed. So the $5,600 minus the $2,300 plus the $1,500 minus the $1,000 gives us net income of $3,800. Notice that there was no, he didn't pay any dividends. So if he had paid dividends, we would not be subtracting dividends to get net income. Net income is simply revenues minus expenses. We don't have any dividends, but I wanted to again emphasize that dividends do not reduce net income. What we're going to do now is we're going to do one question, and then we're going to do a homework problem. So a hint on this one, if you have a list of the type of accounts where we had like the assets, if you go through each of these and see are there two assets identified, that's a good, if you see another type of account, then it can't be that answer. Oh wait, perfect. I just walked over here and it's my Wi-Fi aura. Yes. Oh, we understand. If you're online, you don't need to change it today, but please don't sign in to collaborate with the session ID. You need to sign in with your name, okay? So this is when you're signing in to collaborate. I know there's a lot of numbers. It's just better to talk to someone with name versus a number. How are we doing on this panel? Okay, we've got about 10 more seconds on this one to answer. So which of the following transactions will increase one asset and decrease another asset? So going through there, time to get your answer in. You're running out of time. Okay. The countdown 5 seconds and close it. So 5 seconds, answer any answer. On this one, the correct answer was purchase of equipment for cash. Let's run down why the other ones are wrong. The purchase of office supplies on account. Office supplies are an asset. The on account part says this has to be accounts payable or accounts receivable. Accounts receivable is if a customer of ours is involved. Customers of ours are not involved in our purchase of office supplies. So this one has to be accounts payable, which is a liability. We see it listed under liabilities, so it can't be A. B, the performances of services on account. So on account in this case is accounts receivable because we're performing services for our customers. So our customers owe us, so that's an asset. But the other part of this, if I perform service, that's sales revenue. So that's not an asset, so it can't be B. C, the purchase of equipment for cash. I can look at that. Equipment is an asset. Cash is an asset. Okay, so they offset each other. So it has to be C. D, the performance of service for cash. When we perform services, that's service revenue. So we have service revenue, which is an equity account. Cash is an asset then. So it has to be C, the purchase of equipment for cash. Okay. Now we're going to do short exercise 2-5. Now this one is more free form, and this is just asking for examples of different types of transactions. This is on your homework, and in your homework it's not going to ask you to type in examples, but My Accounting Lab will actually give you a list of examples, and you have to pick the example that fits the situation. So your examples might be slightly different, but I'm going to give you some examples of each one. They'll kind of give you and talk through how we would do that. So your answers might very well be different than this. The thing that would be very helpful on this one is to have the list of the different types of accounts with you. So you've got assets, know what all the assets are, not all the assets, but the list of assets I gave you earlier, the list of possible liabilities, the list of equity accounts. So have those handy because this is going to figure into what you answer. So when you answer this, you won't necessarily have the same answers I have here. You'll have a drop-down list where you'll need to pick the answer. So the first one, we're looking for the impact on the accounting equation. The first one, increase an asset and increase a liability. Okay, so when I'm going through a list of transactions, I'm looking for something that increased an asset, and I'm looking for something that increased a liability. So you have to go through the list that My Accounting Lab gives you of these possible transactions and say which thing has an asset and a liability, just like that question we just answered. So here's two potential answers. So purchase of an asset on account. So if you see something that says we bought a building for cash, or we bought a building on account, or we bought inventory on account, that is increasing an asset, we get inventory, and it's also increasing a liability in the accounts payable sense. Okay? It's also after the semicolon, borrow money is another example here. So borrow money means that we went to the bank, we got cash, and we have a liability now. So that increased cash and it increased the liability. So when you do your homework, you're not going to have these exact examples, but that's what you're looking for. You're looking for, on the list that you're given, ones that have assets increasing and then liabilities increasing as well. And these are just examples. So have the list handy that we went over earlier of what possible assets are, possible liabilities, and possible equity. I did not give you an exhaustive list. I didn't give you every possible asset, every possible liability, but I think they're in the ballpark. Next one, decrease an asset and decrease owner's equity. So decrease an asset and decrease owner's equity. So you're looking through your list that you're given of a transaction that impacts assets and impacts owner's equity. So you're trying to identify those. Some potential answers. If the business pays dividends to owners, we're going to decrease cash and we're going to decrease equity. We'll decrease retained earnings actually. Okay, my second example there is an expense transaction. We bought We went and bought a box of copy paper for cash. That is an expense transaction. We bought copy paper that we're going to use today. Okay, this is an emergency thing. We went out, we got it, we need it right now, so we bought something. Or we paid salaries with cash. Okay, so look for transactions that have an asset and an equity account. Okay, so it could be expense. Basically on those you're going to be looking for something impacting dividends and or expenses, and then you've got the cash side of it. I mean, that's not the only ones, but those are ones to look in your list. Next transaction, decrease in asset and decrease in liability. Again, your drop-down list, you're looking for assets, you're looking for liabilities. So examples, if I pay a liability, if I pay $500 on account, I'm decreasing cash and I'm decreasing accounts payable. So pay a liability is an example of decreasing an asset and decreasing a liability. Another one that's a little further out there is return an asset purchased on account. If we bought equipment and then it doesn't work and we take it back, we're going to reduce our asset because we're taking the asset back. And then we're also going to reduce the liability in that we don't owe the money anymore if we return the merchandise. The next one down, increase in asset and increase owner's equity. Again, you make it through the first couple and then you're saying, okay, let me look at my list. I'm looking for transactions that have assets and equity. So the transaction has to have both of those. Examples of this would be I issue stock. If I issue stock for cash, I'm going to be increasing cash and increasing equity, the common stock. Another example, after the semicolon, a revenue transaction. We perform services for $5,000. We're getting cash, we're increasing service revenue. Okay, and the last one, increase one asset and decrease another asset. Well, increase one asset and decrease another asset, so we're looking on our drop-down list for a transaction that has only assets in it. So this one should be fairly easy when you look at your list. If it affects anything else, it can't beat it. Example, purchase of asset for cash. We bought land for cash. Okay. Another example, sale of asset for cash. We sold a building for cash. Okay, so it's increasing one asset, cash, decreasing another one, building. Collection on accounts receivable. A customer paid us $500 on account. We're increasing cash, decreasing accounts receivable. Okay, now when you do this homework exercise, there's no numbers involved, so it goes pretty quickly. This one, because it was a little more free form, you kind of have to analyze it. It's not going to be exactly what we did in class. If you don't get it right, know that there's a try again button at the bottom. So you submit the whole thing, you can hit try again. So what we're going to do now is I think we're going to end class for now. I think we'll be done for now, so we will see you on Wednesday.